I'm open to questions.
Hello.
Can you hear me?
Yes. Can you? Hello. Yes.
Can you hear us, Mariam?
I can hear you.
Yeah, I have a question. Hello.
Yes, please.
Yeah. So my question is about, you mentioned about exemption category. Can you please elaborate on that and with a specific example for the product?
Can you repeat the question?
The question was about, you mentioned during your presentation about sometimes there are some exemptions possible. So can you please elaborate on that, for which kind of products and how you can avail that?
Okay, the exemption pathway is, for example, the example that we are having to Egypt, the EDA. EDA is open to the exemption pathway, which is number one, you will submit an application, okay? But you will not have a place in the box. They have the idea of imaginary box that's in each generic dosage form concentration in each of, for those three categories, they have an imaginary box of 12 products. They have an imaginary box. So you will apply for the application, and then you will enter a scientific committee first to see your module 2, 3, and 4 and 5, the quality clinical and preclinical data that you are proposing. If you passed the scientific review, you will enter the inspection review, which is the site master file review. If they approve, they will send you to have an on-site visit or on-site GMP visit to your facility. Okay? And then you will be having an GMP certificate. Okay? So because there is no reliance activity, they will do every step, every requirement of the regulations by themselves. They will not rely. Okay? After they approved, so you have a scientific approval and you have a GMP approval, both of them, then you are eligible to have your place inside the imaginary box. So your place, it's okay. So you will, after you get the box approval, this is what we are calling in Egypt the box approval, you are going to have the marketing authorization certificate. The marketing authorization certificate, it's 10 years validity. 10 years validity for the pharmaceuticals and generic. It's 5 years validity for the biological products, vaccines, insulins, biotech products. It's 5. It's 5. So it's lengthier because, for example, the GMP visit and the site master file approval, it's not common in the reliance pathway, and the scientific approval, it's also not common in the reliance pathway. This is in a nutshell the exemption pathway.
Thank you.
Is it okay?
Thank you.
Yeah.
Any questions?
Don't worry.
So anybody want to ask any questions? Okay. So anyone want to ask any queries related to regulatory or the market entry? And if you want any elaborate answers, or some of the startups really they have a product and need to shift into other countries. So we have previous requests also, like from Vaibhav, Lamarck and Statun Labs. So some of the companies they have a request. And the biggest gap is that whom to approach the first, who is the single window. So Access Health having very good network, they can be point of contact. You can let us know with the broader queries so that we can have online discussion one-to-one. Okay, now we can jump into the next session, which is related to financial due diligence, right? We have two experts for these finance-related issues. And as I said, it is not about the just managing the balance sheet. When you are approaching investments, what is your data and what is the data room? So the series of requirements, because what we observed is that many of the startups, when they say investment, but even if we ask, what is the investment, at what stage you wanted to take it further? Because the investor, whenever you approach, he will ask them at which stage and where and what are the requirements. These are the things the initial founders are missing because they are mostly focusing on the product development. So this is one important piece. Maybe from the next two speakers, you can expect knowledge and the answers for your queries. So I invite Punarao sir, so he will take it further. I will request him to give small brief about his work, and he is specifically specialist in establishing startups for the international and global space. Because we have request for the startups, they wanted to initiate operations from USA or some other countries, so he can give you the kind of knowledge required. Thank you.
Yeah, good morning all. So my name is Punarao. I am a chartered accountant with 20 plus years of experience, and I worked with Deloitte for almost like 15 years. After that, we started our own firm. And I've been with IKP, associated with IKP for the last 7 years, and we are enjoying our journey. And yeah, I'm more than happy to answer your queries and questions if you have anything. And until now, we heard about the marketing opportunities and also the regulatory aspects. It's kind of earning money. Now we are going to discuss about burning money, how to burn money in India. So we have to be careful when you burn the money. We have to be having more discipline over when you burn the money. So that's something which we are going to discuss in next 1 hour session. So let us wait for the laptop.
So the worksheet what given to you in the folder will be helpful to guide, because there are again two sections, the section 1 and section 2. It is the guiding questions. Even the requirement, if you do not identify right now, but that is the worksheet prepared based on the journey of a startup. You can ask any of the questions from that worksheet.
Okay. Yeah, first of all, thank you IKV for inviting us for this session, and it's a great opportunity to interact with you guys. So first to just start with, I'm sure all of you, most of you might be having the companies already established, but I just want to brief about the legal structure that are available in India. So we have actually the proprietorship, that is traditional business what we do generally. Like proprietorship is nothing but the individual starting his own business and registering the GST and income tax and all those things in his own name and conducting the business. And whatever profits he is earning, that will be enjoyed by him, and he will be paying the taxes on that. So that's actually the traditional business what we have seen until 1950s and 60s. So after that, the next one is going to be the partnership. This partnership is registered under the Partnership Act of India, 1932. These partnership also like kind of traditional we can say. So what we see in the general business is like 3 or 4 people are coming together and getting into an agreement and registering that under GST and other aspects and conducting the business. And the profit will be shared between the 4 individuals according to the profit sharing agreement. So they will be paying taxes according to the share that they got. So here in this partnership, actually, the main issue is that if the partnership firm is not able to discharge its liabilities, and if it goes into bankruptcy, then the liabilities has to be paid by the partner individually or jointly. So the aggrieved person can go back and attach the properties of the individual partner and also jointly on all the partners' properties. So that's one of the main problems that we have. So the third one is actually limited liability partnership. In limited liability partnership, this particular issue has been addressed. So in limited liability partnership, this is also a kind of partnership firm which is governed by the MCA, Ministry of Corporate Affairs. So once you incorporate LLP, so your liability as a partner is restricted to the capital that what you got into the business. Okay? So your personal assets and personal properties are not attached by the aggrieved person in case if the firm is getting into the insolvency or any other bankruptcy issues. So this is the main difference between the regular partnership firm and the LLP. And the fourth one is company. I'm sure all of you, most of you might be having the companies already established. So private limited company is incorporated under the Companies Act 2013. And we have some regulatory aspects that we need to follow. I'm sure you might be complying with those regulatory aspects, annual returns and other the documents to be filed with ROC on time. And the last one is body of individuals. In body of individuals, it's a kind of society, we can say, like you might be staying in apartments or communities. So you might be coming together and forming a society and registering under Societies Act of that state. So that is called body of individuals actually. So that will be assessed as separate individual entity, legal entity under Income Tax Act. So these are the main structures available in India as of now. So we'll go to the next slide, which is on incorporation of company. So incorporation of company under Companies Act 2013 requires some data and also documentation to be submitted. So first step in this process is like you have to reserve your name. So you have choice of choosing two names, option 1, option 2. Like if you mention the name in option 1, if that is available, MCA is going to approve that name. So once the name is reserved, that is valid for 20 days. So after 20 days, that name is going to expire. So you have to make sure that your company is getting incorporated within that 20 days time. So in case if you are not able to incorporate the company within that 20 days time, you have to extend by submitting another application for the same name. So that's the process for reserving the name. The second step is identifying the shareholders. I am sure the person who is reserving the name is going to be the shareholder. And for a company, private limited company, we need to have minimum 2 shareholders. So that two shareholders are going to sign on the share capital application, like that's called subscription to the shareholder agreement. So once they sign on that agreement, that's part of your MOA and AOA documentation. Once they sign on that document, it's binding on them. They have to bring that particular share capital into the company once it is incorporated subsequently. So for example, if A is committing 10,000 rupees and B is committing 15,000 rupees, so put together is 25,000. And the ratio is going to be like 40:60 because A is saying 10,000 and 15,000 is committed by B. So 40:60 is the ratio. And the shareholding pattern is 40:60. So these are the two guys incorporated in that company. And they have to bring that particular money once the company is incorporated subsequently. So once we complete this share application, documentation, other process, the next one is identifying a director. So for a company to conduct the business, we need to have a board of directors. So shareholders need not be the directors. And also the directors need not be shareholders. In many of the cases, since we are the shareholders, we are the owners, we are more comfortable in becoming a director. So that is there in society, if you see that is the case. But in a regulatory aspect, the shareholder need not be a director. Okay? If you want to bring a finance guy into your board because you are a technical person, you need not give him a single share. Still, he can come onto the board and become a director and help you on day-to-day operations with a remuneration or something, whatever arrangement you guys might be having. So that's one point that you need to keep in mind. And the next one is, once you identify directors, you have to name them in the MOA documentation, MOA and AOA documentation, and file the documentations with the MCA portal. So when you are registering a company, simultaneously there is an option to register your organization under EPF, ESI, and GST also. So in case if you want to register simultaneously, you can do that. Otherwise, you can leave those applications blank to the extent whatever it is not mandatory, and go ahead with incorporation of the company. So once you register, you need to comply with those requirements. That's one thing that you need to keep in mind. Okay. And also, there is an option to choose a bank account. When you incorporate, you can choose your banker and also name of the branch or something. So once you choose, you will getting a call once you incorporate. Those guys will behind you and they will ask you to open the bank accounts. That's the process we have. So this is the process of incorporation. After incorporation, a document is submitted, MCA will verify all the documentation, whatever you submitted. If they find everything is fit, they will issue a certificate of incorporation. So this process may take anywhere between, once you submit, anywhere between 10 to 15 working days. If you are lucky enough, you may get in 5 days or 6 days, but if it is taking time, it may take up to 10 to 15 days. The next one is going to be commencement of business. So next one is going to be commencement of business. Once you incorporate, you have to open the bank account immediately, and the subscription to the share capital, whatever is subscription committed by the shareholders, that has to be brought into the bank account of the company within 6 months. So when you are bringing that amount as a shareholder, you have to clearly mention towards share capital, and don't add any other amount in that particular amount. See, for example, in earlier example, we discussed about A is committing 10,000, B is committing 15,000. So A has to transfer from his personal account 10,000 rupees to the bank account of the company and clearly mention towards share capital. And B has to transfer 15,000, and he also need to mention that towards share capital of the company. In case if they add more amount, for example, the company needs some immediate funds. So along with the 10,000, A is adding 1 lakh extra. So 1,10,000 is going to become. If he transfer 1,10,000 and says that 10,000 is for share capital and 1 lakh is towards a loan to the company, then MCA is going to say that, boss, it's not share capital. You committed 10,000. So the company has to return that 1 lakh to the shareholder A, because this is called excess share application money received. Okay. This is the small mistake that all the founders, promoters are making because of lack of knowledge. So we recently come across this situation in 3 companies. They incorporated 3 companies last year. All 3 companies, promoter is kind enough to send more funds to the company to run their business. But unfortunately, the company has to return that money along with the interest. Within as per the act, within 15 days of the receipt of that money, the company has to return back. Otherwise, it's going to be non-compliance. Okay, that's one thing. Yeah. So, in the example what we discussed, A is committing 10,000 as share application money. B is committing around 15,000 rupees. Within 6 months from the date of incorporation, we need to file a document called commencement of the business. The company has to file that. So in that actually there is option for attaching a bank statement of the company. Once you attach the bank statement, you have to fill up the date of receipt of share application money from A and receipt of share application money from B. Also mention the amount. You need to mention that amounts also, date and amount. So in case if A and B both or any of them are sending more than the committed amount into the bank account, in single transaction. They can send in dual transaction or 3 transaction, 4 transaction, but first transaction should be share application money. In case company need more funds, let them send another transaction, buy of another transaction, but don't combine everything together. It's going to be a violation under the Act. That's one thing that we need to keep in mind. So the next one is going to be like, so you can issue the share allotment certificate once you receive the share application money. Within 60 days of the receipt of that money, the company has to issue a certificate to the shareholder A and shareholder B to the extent of their shares. And the next one is going to be like the board of directors meetings. So as per the Act, we need to have one board meeting at least once in 4 months. Okay? And total board meetings to be covered in a year is 4. So in that case, our suggestion to our clients is that every quarter you can have one board meeting so that you can cover all 4 board meetings requirement. So that is the best approach we can have. So you have any questions or anything, you can immediately we can just cover up that. Yeah, please, sir.
Sir, you mentioned about the share. If there is a board of director,
Yeah.
he may not need to be a shareholder in the
Yes,
company.
you are right, sir.
So can we call board of advisors? Can we call them board of advisors, or they can be called as board?
Yeah, that is coming in the next slide. And actually, advisors are not may not be board of directors,
Okay.
right? So board of directors are more from the regulatory angle of Companies Act. So you need to have 2 board of directors. So they can be advisors to you in case if they have the knowledge in which, like, where you want their help. You can have them as a board of directors, advisors also.
They should and must be registered them in the MCA portal, right?
Yes,
sir?
you are right. Directors should be registered in MCA portal. They need to have DIN number, Director Identification Number. Okay, advisors need not have DIN number because advisors are from outside. They will come and advise you and they go.
So they don't need to be registered if
They
are-
need not be registered. Advisors need. You may have some agreement that's coming in the next slides.
Thank you.
Thank you, sir. Yes, sir. Yes, sir.
Without a shareholder.
Not possible, sir. We need to have shareholders first because they are the owners. Directors are only the operators, we can say. So
And-
you're investing, yeah.
Right, thank you. And what about the term trustees? Do they come into the company also?
Trustee is not part of Companies Act
Company.
because trustee is more of a trust society. I mentioned body of individuals, right? So
NGO.
if a person have more money and you want to create a trust and have trustee, board of trustees, and they will manage that money and keep distributing that money to the needy people. So that's different legal structure. So that's why I have in the earlier slides I have mentioned clearly the legal structures available in India. That's the last one is more of trust. Yes.
Thank you.
Thank you. Right. So the next one is on LLP, Limited Liability Partnership, which we discussed in the initial slide. So limited liability partnership, as I mentioned, the liability of the partners are going to be like limited to the capital they brought into the business. And in case if the limited liability is getting into bankruptcy, they are not liable to pay that from their personal properties. And even aggrieved person can't sue that particular partner for the recovery of the amount. It's different from, through this extent, this is different from the regular partnership form. So for incorporation of limited liability partnership, this is actually, this also similar to your company incorporation, but it's less complicated compared to company. So here actually we need to have 2 partners minimum, and they both are called designate partners. Anything more than 2 is called partner. So designate partners are, generally they manage their business day to day, and they are responsible for compliance and regulatory aspects and operating the bank account, all those things. So That's the reason why they called as designated partners. So once we identify the partners, we need to upload their KYC documentation to the portal, MCA portal. And after that, the first step is reserving the name. Once you reserve the name, that is valid for 90 days. Within 90 days, you need to start incorporating the LLP. After that, you need to upload the KYC documentation of the partners and also office address where this LLP is going to incorporate it. That details also you need to upload along with the proof of address. And also you need to obtain NOC from the owner of that property. In case if you are the owner, you have to give NOC for conducting that business. So that's mandatory under MCA. So you should say that I don't have any objection to run this business by this proposed LLP. You have to give that certification. And that document also should go along with KYC documents of the partners. So once MCA finds everything is fit, they will issue a certificate of incorporation. So once incorporation is done, the last step is the agreement between the partners. So this agreement comes into picture here. In that agreement, you will mention about what is the objects of the LLP and where it is operating, what is the profit sharing ratio, and how to bring the partner, new partner, how to exit the existing partner, and if there is any death of a partner, how to handle that situation. All these things will be mentioned in the agreement. So this agreement we need to submit within 30 days from the date of incorporation of LLP. That's within 30 days. And this agreement needs to be done in revenue stamp paper. I think you might have seen that 100 rupees stamp papers. So we need to use minimum 500 denomination. So once agreement is printed on that revenue stamp papers, we need to notarize the document and attach this document in the MCA portal and submit that. So that is the end of the process for LLP incorporation. So if you have any doubts or anything, quickly we can just take up that in a minute on LLP. Okay. So this until now we are discussing about the company incorporation and the LLP incorporation. Now we are getting into the investor readiness. My colleague is going to cover in elaborate slides, but I just want to just touch the few areas, and then he may take up that next session. So what is investor readiness? So once you created your company and you're running the business, you are making profits, and now you want to expand your business. So when you are expanding your business, you may need some investor. If you have money, that's fine, but if you don't have money, definitely you may require a new investor. So how to bring the new investor, how to attract a new investor is something which you need to work at least 1 or 2 years before. If you're targeting a new investor in 2027, you need to start immediately. So why we are saying this is like you need to do a lot of diligence. You need to attract investor because investor is expecting some immediate returns. If not immediately, once he invests, at least he may expect the returns in 2 or 3 years of time. So for that matter, you need to have a legal framework and structure. You need to bring all those things into your business. So as I mentioned, what is investor readiness is like making the company ready for attracting an external investor by demonstrating financial wellness, compliance, and profitability through committed and trustworthy management. So when an investor come into the company, he will see all these things, how the management is doing. Are they really trustworthy? Are they really committed towards their goal or not? These are the things that he will be seeing there. So for that purpose, what a company need to do is like, the first step is like make sure that all your IP, intellectual properties, are registered and protected. So this is something which we may ignore because you guys might be busy with doing day-to-day business and spending money, spending time and money in lab and other things. So it's very, very important thing that your legal rights, your assets are protected. So our suggestion is please immediately register those trademarks or patents, whatever that may be, with a third-party agency. You may take help from them, and then you can register with the government agency. And the next one is actually comply with all your required filings under MCA and PF and ESI and GST and all aspects. So if it is required, you have to register under EPF, that we are going to cover the requirements in the next slide, and ESI and all these things. So you have to comply with that. Not only registration, you may have to comply and file the regular returns on a fixed intervals. So the next one is on legal cases. So I'm sure some of the startups may get into legal cases, unnecessary legal cases, though it's not your mistake. So you cannot avoid that. So those cases, actually, it's not bad. You need to have proper documentation to demonstrate that there is no mistake from you, or you are in compliance with all the required regulatory aspects. So the investor verify the documentation, factual information. He should be able to understand that, okay, it's clear from your side. There is no issue at all. The next one is maintain employee morale, try to have less attrition. This is something which is more important. Once you start employing the people, you need to maintain certain process of appraisal process and maintaining the morale and keeping the team more trustworthy and all those things. So less attrition and more investors. So if you see in the market also, like if you have the attrition rate less, more investors will get attracted to that companies. And appoint good professional firm for advising you and also doing all these compliances on regular basis, and maintain a proper financial discipline. So you need to understand where to spend, how to spend, and why to spend. So you have to, these three questions you need to ask yourself. In case if you are not comfortable, I think you better off can manage these financial matters if you can give your credentials to her. So she may be a good person good professional to maintain. So first thing is in the recent startups where you have seen is they're lacking the financial discipline. They may not be knowing, it's not intentional, but they may not be knowing how much to spend in plant and machinery and all those things. For example, 3 years back, one of my client is a startup. He got some 10 CR from Singapore, and they ended up spending almost like 2 crores in computers, laptops. So how they spent is they didn't purchase the laptop. They got into lease agreement with one of the vendors. That guy has taken at least 10 to 12,000 rupees per month for each laptop, whereas the laptop cost is only 60-70,000 in the market, but they ended up paying more than 2 crores by the time they realized that they wasted their money. So it's a kind of the professional judgment that we need to use, and finance is more important. Once you burn the money, you cannot get it back. So that's more important. So finally, just to make sure that you are attracting the investors, you do independent due diligence on your compliances and financial matters, so that the prospect investor also come and then find it fit. So if there are any gaps, if you identify, immediately you can address them. That's our suggestion before getting into the investor search. So due diligence. So we discussed about the how to attract the investor, and now we are discussing about due diligence. Again, my colleague is going to discuss on that more. And due diligence is nothing but it's a comprehensive investigation by a third party, that's investor, okay, into your books of accounts and legal matters, and also the regulatory compliances, okay. And before investing, this process will start before investing into the company. So for example, in case if you want to buy a property, we will do lot of research. What is the market price in that area, and is the properties having any legal issues, is the documentation is proper or not. For a simple property, we do a lot of research. A similar fashion, actually, the investor also may want to know what is really happening in the company. Whatever, as a promoter, whatever I am presenting to the investor, if that makes sense or not, he want to understand. And that's the reason why he will conduct a due diligence. So this he may not conduct directly, but he may appoint third-party agency to give the report. So based on that report, he will take a decision whether to go ahead or not, and also what is the valuation. You may give 3x valuation. That guy may come back and say that a 2x valuation I will give you, and you both can discuss and come in between and then close the deal. So in the due diligence, actually, there are 4 parts. One is financial statement due diligence, and the second one is secretarial due diligence, and the next one is HR, and fourth one is tax and legal aspects. These are the 4 areas a third-party agency will conduct due diligence and give a report to the prospective investor. So generally, when you allow a prospective investor to access your data and understand and research, you need to take care of few things. Because he is still a prospective investor, he is not investor. Investor means at least you might be having some relationship, and he is not yet become investor. So in those cases, what we need to do is you have to get into an NDA agreement with them. So don't give them access to your data. It's a very, very sensitive data, and it's hard-earned money you spent on that. And our suggestion is don't immediately give that access to your data. So sign NDA with them. The second step is scan all the documentation and keep them in the folder or shared drive, and give read-only access to them. Don't give them copy or whatever download access. Just give them only the read-only. And the next one is, once the purpose of access is completed, immediately remove all the access for those team members, his team members. And make sure that they are destroying, if at all they have taken any pictures or any copies by mistake, make sure that you are asking them to delete immediately in front of you and sticking to the NDA signed. So these are the 3 things that you need to take care. So if you have any doubts or anything, we can keep it quickly, 1 minute we can discuss that regarding due diligence and... Yes, sir. Non-disclosure agreement. Yes, sir. Yes, sir. Yeah. No problem, sir. Yeah. It's a non-disclosure agreement that contains that once they access the data, they are not compromising with any other third party. And if any financial impact is there because of that compromising, the target company, our startup, will get the compensation for that. So you need to have all these clauses in that NDA.
Yeah. And what is the difference between an investor and a stakeholder?
Stakeholder got elaborate meaning. Stakeholder is a person who is depending on that company. For example, a company dealing with your customers, customer is also stakeholder. And vendor is also stakeholder. So the company dealing with different parties, right? So all these guys are called as stakeholders. Investor is nothing but a shareholder. So shareholder is one among the stakeholders. Stakeholder got elaborate meanings.
Thank you.
Yes. Yes, sir.
My question is about the HR due diligence.
Yes, sir.
And the due diligence, if you could elaborate.
Yes, sir.
And before that, my one comment. So you mentioned about you are sharing a financial statement with an investor, and then it should be, that it's shredded or something. But usually nowadays, they will sign an NDA first of all, but asking for any kinds of financial compensation, it's very rare, especially for a startup to negotiate.
That's true.
It's very rare, and they would likely not agree. This is based on my experience.
Yeah.
Other point is about because everything is shared electronically, so there is no way we can see that how they are handling the document. if
Yeah.
the documents, if that conversation doesn't go further.
Yeah,
So
yeah.
how we can do? Because there is a,
See-
first of all,
Yeah.
Yeah,
So
these two.
for that, actually, you are true that since startups, we may not have that much of liberty to say that. So our suggestion is ask them to come and sit with you and show the documentation and let them note down instead of you are sending an email or documentation. So even you send the financial data, that's still fine. But if you share your technical data, which is your prospect investor, maybe your competitor also, right? Your competitor may come and invest in you. So he may ask you some data, but don't share the technical data, at least technical stuff like relating to your research and other things. Don't share that. So financial data is still fine, that's fine, okay, because it's numbers only, so he may not do anything. But don't share your sensitive data such as your technical data and the customer database and all those things. He may pitch that customer. So this is our suggestion. In case if you need to show those details, let them sit with you and then they can across the table and show the details. Let them understand the factual information and then let them give the report. That's it. That's our suggestion, sir.
Okay, and more about the HR due diligence and the secretarial due diligence.
Yes, sir. Yeah, HR due diligence means it's nothing but employee count, attrition, and how is the morale of the employees, how is the performance, whether the investor can scale up the business with this present capacity or not in case if he brings the money. So all these things seem to come into picture. So for example, if startup is bringing, just before the investor coming, just bringing 20 or 30 employees, just showcase, that is not going to help him, right? So he will go back for 2 years, last 2 years, and see how many employees are there, whether they have UPF number or not, whether the salaries have been paid, okay, and appraisal process is done or not. So all these things will give him picture whether really there are employees or not. So all these things are part of your HR related due diligence.
And the secretarial.
Secretarial is more of compliance under Companies Act and FEMA and all these things. Yes, sir.
Thank you.
Yeah, thank you. Yes, sir. Yeah. So one is financial due diligence. That's the financial strength that he will see. The second one is secretarial due diligence. That is compliance under Companies Act and FEMA and all these things. The third one is HR due diligence relating to the employees' headcount, whether there are any ghost employees, or he will see all those things. And the fourth one is tax, your GST, income tax, and legal cases. So these are the 4 components generally we have in the due diligence report.
Yes, so thank you for the detailed presentation.
Yes.
Here.
Yes, ma'am. Sorry.
So in continuation of Sir's question before,
Yes.
what is the difference between the investor and venture capitalist and how does it works basically?
See, I think my colleague may cover more in that, but anyway, I will just try to tell you. So venture capitalist is nothing but the person who is coming in the initial stage and he will be investing in the, the startup. So they are not going to stay longer time, and they may stay for 3 years or 5 years time frame, and they just make money and they go off. That's the main. Yes, sir.
Hello,
Yes,
I'm
sir.
Dr. Bharat.
Yes, sir.
So, what is the extent of due diligence possible? I'll explain my question with an example.
Yes,
Let's
sir.
imagine I'm taking over a hospital in Jabalpur.
Yes, sir.
Jabalpur is a new place for me.
Yes, sir.
Whatever is mentioned here, the financial, secretarial, HR, everything on paper, I can check, third party can check. Let us just say I also want to do the due diligence for a market licensing capacity of a hospital. You understand what I mean?
Yeah.
The market-
You're saying expansion.
No.
Yes.
Market licensing capacity is how comfortable a hospital and hospital staff in government system to get the money in licensing with other doctors, licensing with other hospitals, other source of patients, etc. These licensing.
Okay.
Okay, the networking.
Yeah.
Now for that, I have to go to the other aspect of the network, the government body where I want the licensing capacity to be tested. And since I'm going to that government body, they will come to know that I'm going to take over this hospital in
I
future.
understand. Yeah.
So what is the extent or the gray zone possible with the due diligence? I'm going out of those papers.
Yeah, I understood.
So is it allowed,
So,
not allowed?
No,
Up
no,
to what degree it is
it's allowed without disclosing that you are doing this due diligence for acquiring this hospital. If your third-party agency is able to get the data, required data for preparing the report, without disclosing that you are going to acquire this hospital, maybe you can try that way.
But the speculations in the market comes. If I'm going and asking, how is this hospital doing, etc., as a third party from Hyderabad to Jabalpur,
No,
people will make
that
speculations.
Yes. Yeah, see, performance from my angle, I will measure through financial data, revenue, all those things. So, in case if you want to see the performance of the hospital, you can see the revenue. But the relationship between that hospital with government agencies is something which you need to do some research, like how many patients are coming from through the government reference and all those things, right? You are saying. So that I think you may have to approach a third party and without disclosing the fact. That's what I feel. But if you have any other option, maybe I think you can explore that. Because that is something more of marketing, and you may have to do some research with the available data. I'm not sure whether you are convinced or not, but I feel you may have to do without disclosing that.
So can we go for next session, the last speaker of today, and the questions and discussion we can continue even after lunch. They are experienced people. Maybe they need to dig out the based on the requirement. You can have a discussion after lunch or while having lunch.
Yes. Just 1 minute, I'll just quickly wrap up this. So we discussed about the board of directors earlier for a company to have. And our other friends discussed about advisors. So board of directors and advisors both are different. Advisors are nothing but the mentors, we can say. And mentor need not be a director. Mentor always give advice to the company, and they after providing such advice, they may just go off. So mentorship generally, I think when you go with incubation center, there you can find the mentors. And also, if it is related to finance and legal aspects, you may approach the right professional for that particular purpose. And when you get into the discussion with mentor, please disclose your goals and objects of the company elaborately, so that they may give you right advice. And the second one is, in case if it is going to be the paid mentorship, there are people who can give you advice with some fees or something. So if that is the case, please get into proper agreement with them by explaining the scope and the time they need to spend on you. All these things, you please make sure that you are mentioning in that agreement, and then get into that agreement and have a successful journey. So other compliances, quickly I will just run through. We already discussed about PF, ES and other things. And PF is applicable if the employees of the company exceeds 20. So until 20, you are safe. You are not getting into PF requirement. And the ESI is something which, the moment you cross 10 employees and the salary of the employees are less than 21,000, then the ESI comes into picture. If all 10 employees are more than 21,000, you need not get registered under ESI. You can go for private insurance or anything, in case if you want to give that benefit to the employees. The third one is GST. GST up to 20 lakhs of turnover, you are not required to register under GST and need not file any returns. The moment you cross 20 lakhs in a year or expecting to cross 20 lakhs, there is a provision for that also. If we are expecting to cross 20 lakhs in current year, you please register under GST and start filing the returns. And filing returns happens monthly and quarterly. And quarterly, if your turnover in that year is less than 5 crores, you can file once in a quarter. If your turnover exceeds 5 crores in a year, then you can file monthly. So that's the requirement. And registering under MSME Udyog, this is not mandatory for the companies, but it's recommendatory. So for availing the benefits under MSME and other things, so you can register under Udyog Aadhar and MSME. The last one is export. We discussed about exporting goods to African market and all until now. by Access Health. They gave a great presentation. So even I feel like I should start my business in African countries. So actually, when you start exporting, you need to register under IEC code. That's one thing. And the next one is registering under IceGate. There is a portal called IceGate. So after IEC code is allotted, you need to register under IceGate also. There are some requirements for that. So once that is done, you can start exporting and other things. So there is AD Banker, all these concepts will come into picture. So once you receive a letter from AD Banker, authorized dealer banker, so they will register the your organization under IceGate. So that is the one. And finally, regarding the company, so once you incorporate a company, every year, financial year, April to March, you need to get your accounts audited and file the required annual returns with the MCA. That's mandatory whether you have business or not. Once you register, you have to comply with that. It's like marrying a person, so you cannot, you have to address their needs, otherwise it's not going to happen that easy. So it's a kind of that. So you have to file all this documentation and comply with regulations. Yeah. And thank you for this opportunity, IKPT, and really it's a wonderful session. Yes. Yes, sir.
Short handbook on this subject?
Yeah, I think our team is going to share this slide presentation with all of you. That's what I have been informed.
Okay.
And in case if you need further details, sir, you can approach Mr. Or IKP team, and they can help you with that this thing.
Okay.
Yes.
Thank you.
So the last presentation is in the sheet. It is about the investments and company building. And most of the times, any startups looking for the investment, the main piece is if they are giving investment, we approach. We see investment portion. But here, what is the investment theme? And do we need to have investor due diligence? Like, of course, investors do startup due diligence. So the kind of factors between these two people, the investor and when the second investor, A series to B series, and second investor is coming in, so what will be the problems? So with some examples, Yugandarji will give his slides to us. Thank you.
Good afternoon. I think this schedule is supposed to happen at 12:30, but we are talking about it at 2 o'clock, sorry, 1 o'clock, almost 1 o'clock. There are hardly 6 slides. You need not really worry about your lunch. I think we can skip this. I can quickly say that I am a chartered accountant with 20 years of experience in due diligences, valuations, M&A. So let us start with the topic, the focus. Are we going to talk about how to raise funds, from whom to raise the funds, when to raise the funds? No, absolutely not. Yeah, I know that most of your curious faces are, I am going to tell you where to raise funds and how to raise funds. Yeah, that is important. That is important. But the point is, when you really think of, I can answer those questions as well, but the time available is very short that we cannot talk about it elaborately. So we'll focus more on what is important when we plan to raise investments. Due diligence. Yeah, Mr. Punarao has talked a bit in detail about due diligence. So I am not going to touch upon what are the components of due diligence and other things. See, why due diligence is done by investors? Who are the investors? Investors are of different types. First, grants. The second is seed. The third is venture capitalists. Then comes PEs. Then comes IPOs. So at different stages, different focus points will be there. But before everything, your technology, your confidence on your technology, availability of the market are the key primary aspects. So when everything is satisfying, that is when exactly the due diligence happens. The due diligence generally they do to validate your claims. The second is to identify risks with the business. determine the valuations. The third is building trust between the parties. So, what is really important? Do a DD, that is due diligence, before someone comes and do a due diligence, the real due diligence. So why do we need to do that? It is to identify the gaps, non-compliances. What happens? Most of you are startups. Either 1 or 2 member teams that you are running. It is not a bandwagon of professionals that you have in your team. So what happens? You engage some professional to go through the compliances that you have done. The early stage startups you need not really worry about because you don't have so much funds to spend. So the financial due diligence aspect is not really a great thing to look at. It is more, they focus more on compliances, whether you have complied with the various statutes applicable to you, maybe GST, TDS, company law, income tax, maybe a few things, but even if you need to comply with your statutory requirements under technologies, various technology acts, that may also be a focus point. So you engage someone, get a pre-due diligence done to understand where exactly gaps are there. So why do we need to identify these gaps? Because valuers focus on the gaps, investors focus on the gaps to negotiate the defects. Generally, they negotiate on defects. One thing you remember that when they signed a term sheet, the due diligence starts only after signing a term sheet. When they have signed a term sheet, almost 70% of the job is done. The 30% job is dependent on the outcomes of the due diligence. In 90% of the cases after the term sheet, investor is not going to go back unless they find serious lapses that threaten the entity's survival and future prospects. Right? So when you identify the gaps, be ready with your answers. So generally, while presenting your business, you are ready with a story. So it is an extension of the story. So why gaps have happened? Yeah, it is not that everybody is foolproof. After all, we are humans, our focuses keep varying across. Primary focus of you is the technology, how to commercialize this technology, how to comply with myriad laws that are in the country. Most of the times, most of the people, even regulator, does not know what laws he has to ensure compliance with. So you identify, get ready with reasons. Wherever possible, you rectify it. So that is what exactly Punara was saying. Get ready at least 2 years or 3 years before. So 2 years, 3 years before for startups is not possible. 2-3 months before you go to the investors, you get it done, identify the gaps, comply with the gaps. Sometimes the compliance is costly affair, so you can postpone. Whatever that can be postponed, you postpone. Then plan for a course of action that you want to present to the investor. Nothing wrong in having gaps, right? But the gap should not be threatening. Get ready with this. Pre-due diligence or mock due diligence helps you in getting the data room ready. Most of the times, the delays in preparing the data room are breaking points. So focus on this. This helps in getting ready for the due diligence. So I am moving to valuation. What is valuation? Data room is a compilation of the information required by the due diligence agency. So I have shared a model due diligence information checklist with Vittal. Probably I request Vittal to share this with you. Yeah. So valuation. What is valuation? So someone who have already raised investments in the past are also there. Someone who are planning to make investments are also here. What exactly is valuation? The objective that we are going to discuss is what is valuation, when it is to be get done, statutory requirements are what is it about valuation, justifiable valuation. So understand valuation. What is valuation? Generally, okay, when you go to a supermarket and get to a shelf and pick up the product, do you really go and bargain with anyone? You don't. These are off the shelf. So investments are not off the shelf, right? So what happens? Valuation is a perspective. When you are really going and investing on a larger investments, let us say a parcel of land, a piece of technology. So that is when exactly the valuation concept comes into picture. This is not price. Price is something that is already agreed. The valuation is something that is a perspective. As a startup, you always think the value of your startup is $1 billion worth. But you have an idea, but you have not started working on it, or it is not market ready yet, right? So what happens? There happens a negotiation. There is a valuation that is available in the horizon. Yeah, Reliance probably when Dhirubhai Ambani has started was not $1 billion company. He started as a small step. The valuation kept growing. Valuation is not static, it is a perspective. So if you say that my technology is worth 10 crores, the investor comes and says, boss, do you have that worth to bring it up to commercialization? No. Unless I invest money, you are not going to realize that value. So that is where the negotiations start. So where exactly the deal strikes is the valuation. It is a negotiated price, right? So you understand what exactly is your valuation, what is your perspective, what is required for valuation. Valuation, to do valuation, information required is the financial model and assumptions behind it. All the assumptions have to be justified. Assumptions. What is financial model? Financial model is nothing but your future financial performance and financial position that you want to present. Financial performance has two aspects. One side it is income, revenue. The other side it is expenses. Income. Let us say, let us take an example of any technology among yourselves. You say that I have technology ready. The immediate question is, what is the price at which you are going to sell this product? Do you have an idea? Pricing strategies play a part. What is pricing strategy? Pricing strategy is something. You have to assess the functionality of your product and its fitment into the market. And then you have to identify what is the kind of pricing you want to fix for the product. Last week we were discussing about a defense product. The defense product was about, they have a tool to identify the distance at which the infiltrators are. So far, how people were identifying was the satellite-based technologies, or they fly unmanned aerial vehicle and find the location, the coordinates. But this time these people have come up with a technology, say they want to run a laser guided distance measurement model. Yeah, they came up, they said, my product, I want to value it. I have this technology, investor is ready, I proposed a value of 25 crores. I said, fine, 25 crores is really good because it is your baby, you always think it is more valuable than anybody to anybody else. So I asked, what would be the price of it? And he was confused. Then he started thinking, what should be the value? He said 25 lakhs. How can you justify that? So financial model is all about justifying the assumptions. The price is an assumption. Number of products you want to sell is an assumption. Assumption and aspiration, it is a combination. So he says, I want to sell 100. Yeah, 100. Who is going to buy? Again, it has to be justified. So financial model, which is the real basis for the valuation, carries whole host of assumptions. starting from the product pricing, the number of products you want to sell, the markets you want to reach, about the competition that you have to consider while making an assumption on the number of products you want to sell, the price, the position. What happens? So the pricing strategies altogether is a different subject that you have to get a proper guidance before you get into the modeling. So once the model is ready, you get an internal valuation done. Internal valuation. Why? You should know first whether your expected value can be derived from the model that you have prepared. Or any assumptions or any modifications have to be carried out to the model, whether they are reasonable or not. Then once you have an assessment of what is your valuation, that is when exactly you start approaching because this is the next immediate question of the valuers. Okay, you have come, tell me a valuation. This question not only from the VCs, PEs, this question starts from the seed funds and angels. Although angels are pretty liberal, seed fund agencies are pretty liberal, but from VC onwards, this question is evaluated very critically, right? So then, who has to value? Who has to value? Is there any qualified professional? Yes, there is a qualified professional. There are, in fact, two sets of qualified professionals in India recognized. One is registered valuer, who is recognized under provisions of Companies Act. There is merchant banker, who is recognized by SEBI and is also a qualified professional to value under Income Tax Act. So, besides these two, RBI also is another agency. If you are getting foreign investment into India, into your entity in India, RBI requires this valuation to be done by a chartered accountant with more than 10 years of qualification. So, there are three types of valuers available, but for Companies Act purposes, registered valuer is the only authority. For income tax purpose, there is a section 56 which requires the valuation. If you are issuing at premium, necessarily almost every issue happens at premium. So the valuation has to be certified by a merchant banker. Are there any ways to avoid merchant banker? Because merchant bankers are costlier. Because merchant banker qualification comes with a set of turnover and the huge premiums that they pay to SEBI for registration. So their fee levels will be high. So only in the startup, as an incentive to startups, if you register for exemptions under Income Tax Act, there are two types of registrations under Startup India. One is the entity registration. The second is registration for claiming tax exemptions or tax incentives. So when you have that registration, you are exempted from getting the valuation done by a merchant banker. Who has to value is already answered. Validity of the valuation report. How long a valuation report is valid? Most of the times a valuation report has a validity of 3 months. Not beyond that. Unless you've already agreed upon and you have entered into a share subscription agreement, valuation is agreed upon, but investment is happening in multiple tranches, a valuation report has a shelf life of 3 months. Statute requiring valuations, I've already told. Income Tax, Companies Act, Foreign Exchange Management Act. These three. Yeah? Or shall we take it at the end of the sessions? There are 3 more slides, that's all. Yeah, we'll move to capital structure. The next question is capital structure. So what form of investment you want? And each instrument has an impact on the dilution. How to compute dilution? This is the objective. So what you have to do? Prepare a cap table. What is cap table? It is not any Latin. It is simple Excel sheet or a table where you list out all the shareholders, number of shares they are holding on the date of proposed valuation. Summarize the investment made. You identify what types of instruments you have issued. Types of instruments. There are equity instruments, there are convertible instruments. Under convertible instruments, you have preference shares, you have debentures. You also have convertible notes. Notes are specific to startups. People are getting confused with safe notes. Safe notes is the guidance concept that was adopted by India under Companies Act as convertible notes. So, convertible instruments have a future dilution, not today's dilution. Again, convertibility has optional and compulsory. So, when it is optional, you have to get it. There are option pricing models that you have to take that goes into valuation models. Then negotiate instrument. Exactly, the instrument negotiation is, you understand equity has an immediate dilution. Equity shares have an immediate dilution. Convertible instruments have future dilution where the floor and ceiling is capped. There may be questions on what is floor, what is ceiling. We'll discuss. Impact on dilution. So, if you are expecting a valuation of 10 crores and you want to raise 5 crores investment, you know it is a very ballpark 50% dilution is happening. So you remember there are 3 critical thresholds under Companies Act. One is 10%, one is 50%, the third is 75%. So what is 10%? 10%, below 10% makes an investor a small shareholder, minority shareholder. See, what we have seen in the past is when in an urgency to pull a team of competent promoters, founders tend to allow more shares to various shareholders. More than 10% has a criticality that you cannot ask him to leave the company whenever you want. Yeah, disputes arise. That is where founders' agreements are going to safeguard interest of each of the founders. So when that happens, asking a 10% shareholder, even statutorily going to NCLT or a court is not that easy. So remember this threshold. The second threshold is 50%. 50% is called simple majority. Simple majority allows you to operate the company in regular manner, where it is not special business unless you want to raise further investment. The day-to-day running of the operations happens with simple majority. Then there is special majority called 75%. When 75% majority is required for passing special resolutions are the resolutions. I'm not going into the Companies Act provisions which clauses require special resolutions. I am trying to tell you the special resolutions are something which are critical for the shareholders' interest and the business interest. So whenever you want to sell off more than 50% of your assets or the business, whenever you want to raise further investments, special resolutions are mandatory. So to get it through, you should have majority more than 75%. So is it necessary, sir? What happens? I tell you the real fact. Although Companies Act is guiding the legal provisions, investors handle these critical positions through shareholders' agreements. Even if an investor holds less than 10%, 10%, 20%, 25%, they define certain clauses called reserve matters, which you cannot act upon unless you have approval from the investor. So even while considering the capital structure, you consider the ESOPs also. ESOPs, you should be ready even before you raise your first investment, because ESOPs are going to be handy in retaining the critical employees, the initial employees who have contributed to the technology. Secretarial. Secretarial is critical. While it was touched upon earlier, what happens? Secretarial means the compliances under Companies Act. To be precise, what happens? 2013, before 2013, there was an act called 1956. After 2013, a new act has come, 2013 Companies Act. But 2013 Companies Act has come like, GST. We make everything simple. But as year passes, everything gets only complicated. So there are a list of compliances, which most of the times, because startups tend to engage with chartered accountants alone. Chartered accountants also have knowledge of Companies Act, but the way the Companies Act and compliances are getting complicated, it has become a specialist job. So company secretaries might be helpful. What happens? Non-compliances attract penalties, delays in raising the funds, and probably people not coming in forward to invest into your entity. And also, a compliant organization always enjoys better confidence among the investors and others. So, actionables. Again, do a mock DD. Maintain a calendar. There are a list of compliances. Maintain a calendar of compliances to see that you are not missing up on it. Board meetings. Yes, board meetings most of the times become paper meetings in the initial stages. But when investor comes, it becomes real board meetings where everyone participates in the resolutions. Have an SOP for investments. SOP means standard operating procedure. Investment. If you are raising investment can be raised in the form of debt, in the form of equity. When you are raising in the form of debt, there are a set of resolutions that you have to pass. Whenever you start, you just gain an understanding of what kind of actions you have to do before raising debt investment, before raising equity investment or preference investment and whatever it is. Maintain a separate bank account. So Companies Act is now, the regulators are getting very, very strict about maintaining separate account for receiving the investment funds. This has so happened that many of the companies have received money in regular operational account. They started utilizing it for operational purposes. But here the condition was that the money has to be utilized only after allotting the shares or other securities that you have committed. If the transaction breaks and you have to refund that money, then there is a separate account that helps them identify. Understand other legal provisions. Other legal provisions happen like, there are, you have to pass special resolution before you make an offer, and you have to pass a board resolution, and also other legal provisions may be about FDIs, foreign direct investments. You have to comply with file the FCGPR within 30 days of making allotments. So there are different time thresholds under each of the act. Under Companies Act, within 60 days you have to allot shares, and after allotment within 30 days you have to file the forms. Without filing the forms, without filing the forms, if funds are utilized, it can be utilized, but allotment resolution should have happened. So these are the critical provisions that you should understand under secretarial scope of it. Legal drafting, What happens? This is the real documentation requirement. When investment happens, you need to really understand at what terms an investor is coming and what terms to maintain the relationship with the investors. This is very, very critical, because Once you raise your first investment, complying with those investment terms and conditions is really going to be a benchmark for the next investor. Whenever they conduct a due diligence, they really notice whether you are in compliant with the earlier investment conditions or not. So, actionables. Any investment starts with term sheet. There are critical things that how much of the investment, what is the instrument, timeline, pre-investment activities, whether due diligence is going to happen, valuation, independent valuation, or mutually agreed valuer, or your valuation is going to be accepted, and then in how many tranches the investment is going to happen, any milestones that they define, and then they also discuss the conversion terms and conditions and exits. This is nothing but a summary of the conditions that the investor is going to put up. But is this final? Most of the times it is final. Maybe 10% of the conditions are open for negotiations upon completion of the due diligence. Investment subscription agreement. Subscription agreement is the first document that is going to capture after the due diligence when they said, yeah, Vital, you have any concern? Right. After the terms due diligence happens, the timelines they define into which account they have to transfer the funds, within how many days. This is pre-disbursement conditions there will be in the subscription agreement. Once you comply with those conditions, they are going to pump in the money into your account. Then investors agreement. Why I am saying it as investors agreement is shareholder agreement, debenture subscription agreement. I don't want to really distinguish, so I said investment agreement. Investment agreement is the final definitive agreement in which all the terms and conditions that are negotiated and frozen, agreed upon mutually, is documented. So you understand the terms and conditions. There are tag along rights, drag along rights, exit terms and conditions. When there are convertible instruments, the conversion conditions, milestones are defined. And the same agreement is going to talk about floor and cap valuation. Floor and cap valuation generally happens when the dilutive instruments are issued. Future dilutive instruments. What happens today? You have entered into a investment at a valuation of 10 crore. Tomorrow another investor has come, you proposed a valuation of 30 crore. So the earlier investor has anticipated that in next 6 months your valuation is going to go up only by 1x. That is, it is going to become 20 crores in next 6 months. But within next 6 months, you started raising investment. And you said 30 crores. But what has happened? There are conditions that it should happen at a future valuation. So 30 crores. So the first investor is at the losing end. So he wants to put a cap. If it goes beyond this, the valuation, the conversion valuation should not exceed this particular point. That is the cap. The floor. Floor is always anti-dilutive, that he has come at 10 crores and future you are going to issue further instruments at less than 10 crores valuation. He has already invested, so he is at a losing end. So to protect that, they put the floor. So amendments to AOA. All the terms and conditions which have an impact on the day-to-day operations of the company have to be incorporated in articles of association. That is mandatory. But most of the times this is ignored. Why it has to be incorporated in AOA? Because AOA is a public document. Anybody can download from the website of MCA. But if these are already incorporated, but shareholders agreement is a private document. Unless these are incorporated, the future investor happens most of the times when you share the information memorandum, people download the data and everything that you have filed with MCA, they go through that. It is not necessary that they depend on you. There are several portals, at least 10, 15 portals. They need not even go to MCA, Pro 42, INC 42. There are host of who are sharing 60 pages, 70 pages document with the investors to understand your compliance position, your past position. So they'll understand. So you have to incorporate the terms and conditions into EOA. Investor relationship. Yeah, once agreement is done, investment has done, it is not that I have crossed the bridge and I have burned the bridge. No. The relationship, the confidence of the existing investors. Most of the times, the early stage investors, once their first stage fund exhausts, they raise the second stage fund. They continue to invest in the investee company in the further rounds also. And they also connect you with the prospective investors. So maintaining relationship with the investors is a very, very critical thing. At this point of time, for the reserved matters that are defined in the investors agreement, you gain an understanding. Is it that investors are very strict? No, investors are here to multiply their investment. It is not to stop you from doing the business. You understand that. But the point is they want to protect their interest. That is why they kept the reserved matters. So, you understand the reserved matters. Wherever you are finding it difficult to navigate through these reserved matters, you take help of the investors. Ensure performance commitments. See, whenever you are doing a valuation, there are certain assumptions. Those assumptions become a benchmark. And every future performance is going to be linked with the performance you have already projected. So ensure that you are trying to meet those, if not really meeting. Your efforts are towards that. And obtain positive concurrence, even if certain conditions are not there in the reserved matters, you still discuss those things wherever you feel their inputs are relevant. Because investors understand the investor community well, the valuations well, and the prospects of your business well, more than you. Continued communication, exchange. Generally, quarterly financial information exchange is a condition. Monthly, half-yearly, or annually, you keep sharing. You might feel that it is going to be very burdensome on your timelines. Most of the promoters, founders want to focus on their business rather than doing everything else. If you don't want to, then certainly you are going to lose the confidence. If you find it difficult for yourself to deliver, you engage someone to help you in that, but don't miss on anything. That's all. We come to the end of my presentation. Any questions? I'm ready to take.
My question is about the, you mentioned about if there is a less than 10% stake, it will be minority. However, I had seen a case where even if there is a minority investor, they have this clause about drag along rights, where they say okay, for the next round, or if they feel at a certain stage there is a good investment, they can drag along the promoters and they can have push for the sale of the assets and so forth. So, but it is a minority stakeholder, how they can invoke the drag along rights? So that is
Sir, actually, let me tell you, like limited liability concept under Companies Act, which is a myth. Why Vijay Mallya is running away and staying outside India, although his company is a limited company. Exactly the same reason that applies. There is another act called Contract Act, Indian Contract Act, that really, enforces the terms and conditions you have agreed upon. As long as the terms and conditions that you have agreed upon with the investor are ultra vires. Ultra vires means illegal, beyond the permitted legal boundaries. You can agree upon such conditions. If once you have agreed upon that he can drag you along, you have to. There's no choice. But the point is, no investor wants to drag you along with him, because most of the venture capitalists do not have the wherewithal to carry on the business. They do it only when these are VCs, and VCs see an opportunity in a strategic mergers, acquisitions. that you are not supporting because you are sentimental about your company. That is your product. Everybody have love and affection towards their baby. They don't want to send them off. Even in marriage, you see it very difficult to send them off. Right? But if in his interest, the investor is ready to sell it in his interest, you are not cooperating, that is when they drag you along. Otherwise, they don't. Although these conditions are existent in every investor agreement, you need not really worry as long as you are delivering and not stopping the investor pursuing the beneficial ideas. Right.
Once we go for the valuation for the first VC pitch, you also mentioned that professional valuation is an expensive business. So if we do some kind of valuation which may or may not be equivalent to what it really should be, and by the time we are in and we do the valuation, the gap is too much. How to cope up with that? Can you throw some?
There are two things that you need to keep in mind while talking about the valuation. Is valuation really important for angel level of investment, seed level of investment? No. By the time you reach VC, you already have a finer visibility of the model that you have envisioned. So you will not really face an issue. But the issue is, what valuation should I propose to the seed investor, angel investors, right? That is where. Yeah, you can.
Not really angel or seed, like if there is no, there are some valuations if you don't have any strong financial model in terms of medical device, the sales is coming very long after the operation. In that time, there is no actual factual data.
So generally what happens, about 10 years back, we started working with a company called Sub-Rent Karo. When renting, the shared economy was being marketed like a crazy thing. So till that point of time, Farlenco or some other entities were there in the market. The question when we started preparing the financial model, it is a costly affair, but it is a valuable input. The point is, are there any comparable platforms or any complementary platforms or something that you are going to replace? That is something that is going to guide you for the financial projections. See, most of the times, how you have to engage the professionals who are really, worthy professionals, you have to engage them through equity, or where you need not really spend money, but you can give him options. That is how you get the worthy input without really burning your cash on hand. But you have to get it done. Otherwise, you will really not have a proper perspective while approaching the investor. Any further questions? I think it is lunch time.
It's lunchtime. So before all the guests leaving for lunch, any further queries or the questions you can approach after lunch with the experts and the speakers. At the same time, of course, I thank our speakers, Dr. Girish and Kalim and Punaragaru and Yugandhar for the valuable inputs. I know that they had raised important questions than answers. So be connect with IKP Prime team. We are going to have one-to-one sessions even if you require. Thank you for attending this session. Thank you.